All right, it's April 13th, and I'm Tim Quast. This is the Edge demo and discussion. Welcome, and happy to have you all here. Any observations before we jump off? I see some eager faces there. So, you know, if anybody wants to speak up, go ahead.
You know,
Otherwise,
what's interesting?
Where is the money coming from?
Okay, well, that's a good one, Steve. Barry, go for it.
No, it's interesting. We're at 7.3 broad sediment, but you look at the fangs and, you know, their supply is below trend. It's rather interesting to see what's happened in the marketplace and the run we're getting today.
Yes.
I've been sitting there all morning kind of to scour going, okay, where, just to Steve's point, where is the money going? You know, and how do we play tomorrow? And of course, we've got the banks, and even the banks kind of look okay. So kind of interesting.
I don't disagree. Now I can only tell you from a data standpoint where I think the money's coming from. But let me just make sure here I haven't missed any. Where's that data, Andrew? So here, I'll show you. Let me just do this really quickly. You're talking about the data John's using, right? So there are multiple ways to skin this cat, but John, and you may tell me. So I presume that you go over here and you collect. You will query all stocks by say all stocks that have. I don't know how you did this, John. I'm just going to make it up on the fly. So I would do market structure sentiment that is greater or equal to 1, right? That should give me everybody, right? We'll see. Let me filter. And it should be, the data set is that's pretty close. I mean, I'm not sure if that's exactly it. Around 3,120 companies in the data set. If we had everything in the entire NMS, and what are the reasons for the variance? It could be timing, could be this. We try to keep it squared to the S&P global data that we license. But there would be, call it 35 if you kept it, 3,500 if you got everything that's in the NMS, the National Market System, that Wilshire tracks. That's pretty close. I mean, we'll be off by a few basis points of market cap, but not by much. So I don't know, John, if that's the way you did it, but that's a way. Not that I'm trying to encourage you to dump all the data, but you can query for all the data and then export that to Excel, and then you could look at that by the demand or the demand trend. I think that the pivot table way is to look at this by demand trend and by sector, and you could sort the whole thing and look at this is what the output sort of looks like. Yeah, John, is that you?
Tim, are you sharing your screen?
I thought I was. Am I not?
Okay.
Let me do that again. Oh, maybe I just dropped off there. Yeah. Okay, hang on. Let me do that again. Okay. So sorry about that. Thanks for telling me. Okay. Thank you for doing that. I appreciate that. Okay, so let me go back to the data here. What I did, I put one criteria in and said market structure demand is greater or equal to 1. I mean, everything's going to be at least 1. And so that should give me the whole data set. And then you could export that to Excel, and then you could, pivot table it into that view so that you could look across it and say, by the way, there are a whole bunch of them now that, looking at the data today, that have a downtrend. Like materials was 53, it's like 67% today, I think. But it gives you a pretty good look, right? You say 20% of the market's topped, 35% is trending, or is top, 22% up, 35% top. This would be helpful if I just do this so you can see that better. But it gives you a good sense of where the market is. That broad sentiment's going to do that. It's going to take the S&P 500 extrapolation from that data set to give us a good read. It's a very simple read, and I'll tell you why. Looking at the data, all we can do is look at the data and then draw. We could wander into all kinds of weeds, but to me, it's pretty simple to tell you why the market is doing what it's doing. And remember, it's not linear. I always try to make that point that when the market is topped, it does not mean that you can't get a strong day. But that's what catches people out. Because you think, oh, well, the market's off to the races and we're looking at data and we're going, well, but that's not right. Well, it will come. Statistically, it hasn't failed yet that the data have been good at predicting what's going to occur. Okay, I'll answer the question, at least from my view, where the money's coming from. Oh, we lost John. Okay, let me admit everybody there. Okay, then just to make sure. Okay, good. John, we couldn't hear you, so hope we can now. Okay, there you go.
Now?
Yeah, we got you now.
Yeah.
Okay.
So what you did was right in terms of the ability to pull the data. The other thing I do is I like to look at it because I believe your broad sentiment is just based on the S&P 500, right?
Yep.
And
yep.
What I do is also do like a lookup table just for those stocks. That's why I want you to create that S&P 500 portfolio for me, so I don't have to do that part. But then what's great is, you see this, the top bottom, just for that S&P 500, and I correlate that with like where broad sentiment's tracking. So if I go and look at my data today, which I sent you, what I could see coming into it the last couple of days was that, starting on like from the April 4th to the 5th, we had like stocks topped at 21%. Then they started the amount that were topped, on the 5th was like at 40%. You saw that the next 3 days, and then you saw, the uptrend declining, and you saw the downtrend starting to decline. So that to me really is like how we make tops, right? Like you're not going to go straight down. Today I think is another, potential if you want to do SH or something, probably sell into this rally. This is an investment advice, but that's a potential strategy.
Right. Yeah. Well, and here's how I answer the question about where's the money coming from, Steve. Back to your question, and what causes it. What Barry Norton was talking about is this: looking at big tech. You can just look at that. That's it's a 30-day read of demand, which is fine. It's better than 5. We got convergence yesterday. That can be. It's not linear either. It can change, but it's not terrible. The supply is below trend and demand is just tailing off, but better than 5. So you look at that and say, well, the market's not going to fall apart, probably. Then I look at broad sentiment, and I've talked about this, that there was this huge, that's the bank short, right? This is the concern about the financial sector. You could really see bets put on right at February expirations. And if you look at the financial sector back then, it was heavily short. All of that has come off. And if you look at the last 2 days, this big drop in the supply side is the reason that the market is up now. And so then you'd say, okay, you can look at that. I got that. It's a supply side move because the demand side has peaked. Doesn't mean it won't, it can't stay here for a bit. It happens. But it's not demand. It's diminishing supply. So then you can go look at your dashboard, and there are 30-day trends. Looking at this is a 30-day view, but you can look across here and see how prevalent passive money is. Passive money again is index funds, exchange traded funds, and quants. And it's interesting. It's not the passive money doesn't just follow the market. That's not the way it works. You could just Google rebalance, institutional rebalance, and it's very interesting to go read firms their perspective on that and how much and how frequently they're adjusting their models. What happens if everybody goes back to 60? It's not been 60-40 equities and bonds. It got destroyed last year. People are now returning to that strategy. Well, where's that money going to go? I think that happened in March. That money went into big tech, and it was happening at March expirations ahead of the index rebalances, and that's what pushed big tech to all the way up. That's manufactured stock. That's all been covered. There was more demand than supply, so market makers create stock to fill it. And you'd say, well, if it's heavily short, won't it go down? Yes, it will, but that will, in the short run, meet the need for additional supply in the market that everybody's consuming. So that can have an effect, and it's validated by just looking across here. Passive, 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 passive. It's everywhere. Passive money is the dominant force in the market. It will concentrate around the largest components of everything because it needs liquidity. It needs size. It's very difficult to get in and out of small caps, which is why now, in particular, small caps don't perform the same way as other parts of the market. And it's not a good barometer anymore for, we used to be able to say it's growth. If you look at the small caps, the Russell 2000, if that does well, there's a clear signal that growth is that people have an expectation of growth. Well, what if it's just asset allocation? That this assumption that the market reflects people's rational thoughts about the economy has to be dispelled. And I did it in the blog yesterday by just pointing out that from 2008 through 2021, real GDP was up 22%. Inflation, real GDP is supposed to be adjusted for inflation. But they use, the numbers are generally what's called the personal consumption expenditure deflator that is used. So it doesn't match CPI. There are pieces that are factored out. CPI over that time is up 29%. So if real GDP is less than inflation, are we really growing? But the market sure does not reflect that. The market has done much better than that. So it can't possibly be a barometer for the economy. I wish it were, but I think those are important things to think about. So we have two things: plunging 2-day supply, broad market sentiment topped at 7.3. Then you look across here and say it's passive money. Here's an interesting thing to do. And I'm not saying you need to factor all these things into your thinking, but it's available to you. It's to put SPY. It's the only ETF we include on the platform because we use it as a price proxy. I don't want ETFs. It's not that we can't, but I don't want them distorting the asset class, which is equities. ETFs don't create more stock in the market. They create substitutes that expand the access to the same underlying pool of equities. That's important to understand, but you could look at the trends in SPY. What is it doing? Well, it's been reflective of the same condition where there's been insufficient supply and excess demand. It tends to spend a lot of time at 5, but it's tailing off, and supply started to rise again yesterday. I'm not predicting what's going to happen, but remember, the ETFs and the underlying stocks tend to move inversely because it's an arbitrage trade. If the ETFs are trading at a premium to the basket, you short the ETF and you buy the basket until they move the other way, and then you reverse that trade. And there are other pieces in it. But I look at this and say, what has been occurring is the money's about to leave. So the market makers for ETFs covered equities, and then equities go up today, and they turn around and they supply those equities back to BlackRock, Vanguard, and State Street. This is the mechanics of the market. This is the more complicated piece. The simple piece is very clear. Supply dropped and passive money's responsible. And so prices rise. Passive money is very large. The more complex element is when this process begins to shift, this is what will happen. Market makers are not handling customer orders. It's principal trading. They can do this stuff. So they will have covered the basket. Now those stocks are up today. You turn around and give them back to BlackRock at an elevated rate, but you're beginning to short the ETFs, which you will turn around and sell. And there will be a consequence out of that. I don't know when that'll come, but we have a pretty good idea. And so that's the way that the market works. There are $7 trillion in ETFs. It's a very large and high turnover element of the market. And so it's not that you have to worry about that. Broad sentiment's all these things are going to tell us all inputs. And so we already know that we're above the red line. And really the only reason the market is rising is this steep drop. Well, what follows steep drops? You can go look across the entire data set. It happened here too. And we got a sharp run in stocks. And then as this begins to rise, at some point it slows down the market. It hasn't all the way because it reversed. But the trend, what is the probability here? If you were looking at this, would you say that the probability is that this continues on down? Well, there's always that possibility. There's nothing precludes it. But looking at the trailing data set, it's improbable that rate continues. It's highly probable that this begins to rise. And if it goes back over 50 and this begins to deteriorate, the market will decline again. Do I care? Well, look, we all want a market that will deliver returns for us. That's what we're concerned about. And that's all I care about in this context, that we produce returns, and we have to go with the probabilities. So that's what I look at. If the probabilities weren't supported by relentless repetition in the math that is accurate, I'd be more concerned. But I know that that's what it reflects. In fact, so I have put I'm not recommending it, but I've probably now close to 25%, maybe even more than that. I think I bought a little more. I may be 30+% short the market, SH, because at this level, I think, well, and I don't really care. I'm looking further out, but because the math suggests historically there could be big spikes that can happen, but math suggests historically that something more akin to this is likely to occur than something akin to this, given the math. So that's the way that I look at that math. Okay, so comments, thoughts, observations, and then I'll move to point number 2. Anything? Any hands? Okay, I just dropped my pen. Sorry. Okay. Let's go. Okay, so let's go to the next thing, which is, and I always like to do this, about examples, and because it's the best thing to do. And by the way, what the data is telling you. If you look here, this data set, this mirrors that from the 12th of January, which is the fact is, it's a data set that fits a spot in the frame that the software provides, but this is identical to what you will see in the portfolio view. So if you go in here and we look at the one momentum stock, and you looked at the data visuals here and you drop this down, it would be the identical period of time. That's what it's doing. It's trying to match that period of time to broad sentiment. And so the trend line here reflects this whole data set. If you look up tech up here in the quick search, you're going to get a 30-day trend, right? Everything else is built around a 30-day trend. It's just that the portfolio view should match the broad sentiment view, and it's a space element. So it's the amount of space that we're consuming. I just want to make that clear because it can be confusing. Like, what do you mean by the trend? If we look at the D trend here, what does that mean? That's going to be a 30-day read. 30-day is a very good read for trading purposes. Why? I've mentioned this before, because things relentlessly change every month. Hedge funds send out statements, they make adjustments. Risk strategies change probably twice a month at options expirations and month ends. Indexes have to tweak and get rid of stuff that's skewing their tracking. Tech, for instance, tech is in the materials group. Well, it's going to be jettisoned by passive money because it's a deal stock and it will skew from the mean, and that hurts my performance as an index fund. And so they're going to make those adjustments all the time, and a 30-day view gives you a very good read on what to do. So now to the examples. So I own tech. Do I love deal stocks? No. But in a condition where the market is likely to be more tumultuous, that if it's continuing to give us 3.5% potential moves, and you look at the supply-demand equation, demand very strong, supply all the way down here to 24.5%, that everybody thinks that whatever occurs, whether Glencore buys it or it splits into two companies, whatever happens, there's probably upside in it. I'm not going to hang around. I'd like to get my some 3% and move. But I'm just going to keep coming back to the data. It's the only thing in the momentum portfolio now. And what does that mean? Well, the data is warning us away. If there are 30 in here, we have glorious momentum opportunity with limited risk. If there's one, we have very limited opportunity, even with the market doing what it's doing today. Could give it all back tomorrow. I'm not saying that'll happen. I think the risk mounts into expirations next week. The options for April expire next week, and I think it will be, once again, a very important turning point that people may not be prepared for, and of course, earnings will be blamed. I don't know how the banks are going to do. We can look at the financial sector; they will be kicking off here shortly, and you say, "Well, that looks fine." There's weak demand; it's only 5, but the supply side's pretty good, and we know that just looking at broad sentiment, all that shorting related to risk in the banks has come off. It does not mean that the risk has gone away. It's that the trade associated with it has. For right or wrong, it has. You look at the big banks, maybe they're better. They certainly had a little more demand, but I look at the big banks and they're not that great. This is, if you look at JP Morgan, 32% short, that's pretty good, doesn't move much. It's topped right at 5. It's a low volatility trade. You'd look at that and say, what do people think that JP Morgan's going to report? Well, based on that data, you would say that they don't expect anything bad. There's no, even all the way back to March expirations here, there is no indication that there's any kind of short bet. If anything, there was a lot of covering in JP Morgan right when the regionals were falling. The regionals did almost the opposite of this. So, you look at that and say, oh, everything's fine. So what would cause the market to fall apart? Who knows? Who knows? I'm not saying it's gonna, but it's very important to think about these data points and how to understand what they're telling you. A couple other things. So I've owned BABA twice, and I don't know if this happened to you. Well, all of a sudden it implodes, right? Well, what do? I made very nice returns in BABA. I came back to it because it was a 10 with falling supply. And then all of a sudden, yesterday, I intended to sell it, then it drops 5%. Well, today it recovered some of that. And I just, you have two choices, always. You take your lumps when the supply demand equation changes. You could say, well, maybe it'll be fine. It might be. But I look at the falling demand and I'm either going to leave or I have to wait and ride it through to the next exit. And you can do that and I might do it in something other than that, in an ADR where there's much more arbitrage, much more intra-market arbitrage. You could trade it in Asia, you could trade it in the US, and it distorts outcomes. That ADRs behave very much like the ETF arbitrage trade, so there's greater risk in them. So I cut my, fortunately I did very well in other things. I did very well in BABA before, but I lost $800. I don't like to lose money. I am not a fan of losing money, but I just cut the losses and left. And did very well in El Nilam because it collapsed and then it recovered. It was a great example of buying something down its volatility when supply and demand clearly indicated that it could deliver gains. Now, what would you do? If it's a 10 and you're at 55, 56% short, look, to me, you should be out. Right? That's a reason. There's too much supply. So even though demand's strong, good reason to leave and go find something else. I bought yesterday. Why is this not in the momentum portfolio today? I don't know. I'd have to look at the precise elements of the calculation to understand why. But this, to me, yesterday, with dropping supply, strong demand. I don't love the sector. It's an energy company, and I could make an argument for and against it. Healthcare is the better sector. It's giving us more opportunities. Clearly, that's the better place to be. But I look at that and say, well, that's worth owning. But again, I'm not going to hang around very long. It's done well. These things have all of that has more than offset the damage from BABA. But it happens. Sometimes it happens, and what are you going to do? You just have to, keep moving and use the probabilities. They will generally be right. Steve, yeah.
Okay, going into your financial, if you can go back to that, how do you account for the Fed's pump? I mean, the money that's going into these banks is greater than it's ever been in the history of our world, and they're going to be able to show this in their earnings as part of their earnings.
Yep.
So how can you even try to decide whether to go into these bank stocks when you see their earnings come out and everything? They're false. The whole thing is fake.
I agree, and I think the dollar's showing that. If you look at the U.S. dollar, I keep and it's like it's a data point, but I do keep this always readily at my fingertips so I can check it. And so if you look at the dollar, this is the 3-month view of the dollar, and right at the bank crisis. It was a little bit after that. So, here it's 105.60. By the way, this is the DXY measures the relative value of a basket of major global currencies. So they're all falling and they're all depreciating. Purchasing power is diminishing in all related fiat currencies. But that was a strong buy. Look how much we've come down since. There's the effect to me, Steve. That's what it's followed the chart of the supply in the market. The short volume has come down at almost exactly symmetrically with the dollar. And this is very unusual during a tightening period. Normally, when there is tightening, financial tightening, the dollar strengthens, which, if you go back a year, you can see that. This is what you would expect to see as the Fed lifts rates. The dollar should become very strong relative to other currencies. And instead, as we've continued to lift rates, the dollar has deteriorated. This isn't market structure, but it's an important thing to understand. And it tells you, to me, two things: that there are contradictory currents. The use of money to bail banks out increases the supply of money and sort of is cognitive dissonance relative to what the Fed is trying to do. When the Fed says we're trying to fight inflation, but the dollar weakens, what happens if they lift rates? Inflation will explode because inflation moves inversely with the value of the dollar. If the value of the dollar diminishes, what you buy increases in price. Your money doesn't go as far as it used to. It's that simple. So I see that there, and you're right. And I also think there's some crisis in confidence in the dollar that's developing, and those are troubling things. So you're right. I'm not, trading financials is a dicey thing because of those interferences.
Well, you can look at the comparison of the peso to the dollar, and Mexico has basically left the dollar. I mean, there is no relationship anymore. So how many other countries are that way right now?
Right, there is discordance, and that is new too, isn't it? I mean, we used to see policies generally follow each other, and the Japanese central bank and the Canadian central bank and Swiss, they're all doing their own thing, and it's interesting, all right. And how is that going to affect what happens in equities? Well, market structure reflects every known input. We're going to see it. We will see how people bet for or against those currency balances. Okay, Andrew, let me see if I can get you. How do you trade tech? You plug your nose and there are no pullbacks in that there. You could jump. Well, there are pullbacks, and I did buy the pullbacks. I absolutely did. That's what I did. When it dropped below 43 down to 42.50, and I bought several hundred shares there, and I added to it. So you're right. It's deal stocks behave differently, and the only time to me where they're really worth trading is when there is great uncertainty. When the market is topped, and particularly if supply is rising, you're more likely to get returns in deal stocks. Now, if there is no volatility in them, there's no sense in it. But we try to screen those out of the momentum portfolio by setting a limit on the downside in volatility. We want volatility, that's in value, sorry. And here in the momentum portfolio, you got to have at least 3% of volatility to even make the cut. Most deal stocks don't do that. So it's kind of a rare, opportunity in that sense. And if you look at PXD, is a clearly known deal stock, and yet these levels do not, to me, reflect this 35.6% yesterday. It's well below trend, but that isn't, deal stocks, we have tracked this for 18 years, and it's been and out of that data set for the last, since 2010, whatever that, 13 years, we've been able to look at short volume and understand the relationship in deal situations. We've been very successful in doing that. In the Fox Disney Comcast battle, so 21st Century Fox was our customer in that transaction, and we could tell them exactly what was going to occur, and their bankers couldn't. We told them there's going to be a competing bid because that's what the deal ARPs say. The bankers said, no, there won't be, and there was. We could tell them when the bidding would end because short volume jumped from 30 to 43%. We said the bidding's over. That's the winner. And it was correct. So these are very, very good data for understanding what's going to happen. I look at this and say, interestingly, at this point, the deal ARPs think less about this than they do tech. So that's a good reason to me to trade tech. And I'm not going to hang around waiting for some potential premium. I mean, it's already at the level that Glencore said it was willing to pay. But if you're going to do it, Andrew, these are the times, not when there's a whole bunch of momentum opportunity. No sense tying your money up. Steve, yeah, please. And anybody else?
Sorry about that.
No, that's okay.
Tom, I got a question for you just on,
yeah, John.
So when I'm looking at the supply side, I just want to make sure that I'm looking at this right. So the default that comes up is like, it looks like a 3-month look back, right? And so if you look at that line, like on this chart, it's trending down. But when you look above where it says, supply trend, that's just a 1 month
that
view.
Exactly.
Market is, right?
Yep.
Okay.
This is a 30-day. Yep. That's a 30-day view.
Okay.
If you want to match, yeah.
I was just saying, like, walk me through that again, kind of just how you think about using supply for entries and exits. I just want to get clear on this. I think this is the hardest thing to understand about Edge.
Well, I love the Hicks rule, which is, and let me go to a perfect example of that, which to me is, I mean, Tex is good an example, as you will find, given that it's a deal stock, but it's if demand is rising or at 10 and the supply falls day over day, this particularly is good. It continued to fall here, not as much, but that's a great example. Let me see if I can find an example in here. Oh, I'll tell you what, I've got a sort that I use for this, and it's bear with me here. But
so anything supply below that dotted trending line is a good signal if you're looking to buy, for instance, right? And anything above that is kind of when you're really starting to see a cap on potential upside, or
yes,
you expect the stock to start going down. Okay.
And then the other side is, when do you leave? Right? Is it immediate? Right. That's the harder to me. The entry point is, to me, relatively simple, and I don't overthink it at all. Andrew, to emphasize this point. If I've got two choices and one of them is flat and one of them is down 50 basis points or 1%, and they have the same supply demand balance, and it doesn't always work. It doesn't always work. That's a mathematical fact. You can't control. There are variables in there that will alter the outcome. But I'm going to take the one that's down because I prefer that against the math. It is better that I will produce a return, because even if it's down, it might recover it all today. But in the next 2 days, I'm very likely to get the return that volatility indicates, 2, 3, 4%. So I prefer that. I don't always do that. There are times when if there's a lot of momentum and something's already up 70, 80 basis points, but it moves 3.8% a day on average, I might buy that. And sometimes that doesn't work, but a lot of the times it does. If supply and demand in the broad market are moving, the sector looks good, there are a lot of choices in momentum, probability is you're going to get a movement. And again, I don't overthink it. Steve Hicks does a better job nuancing it. Barry Bailey, I think you do that too. I don't nuance it very much. Here's this short-term value portfolio looks for stuff spending a lot of time at 5, and I'm just we're always studying data, and so it's not that I'm saying, oh, here's the new holy grail by any means, but notice that it's at 5 and it's looking for day less than 45% short and day over day decline, because in a market that's very volatile, probably money goes into stuff like that, and that's what we look for in the low volatility portfolio too. But this is really isolating for that. Then when do you leave? I mean, if you look at this short, This is short beta, 107 stocks. So even though the market is way up today, this has gone from 10 to 107. It's up by a factor of 10, 9, I guess, mathematically. But that, if the supply line jumps above trend, I'm certainly gone. If it moves a little bit, I don't necessarily leave, but once it moves materially, I don't know what material is. Let's say 10%. If it goes from, if it's 45% short and then it's 50, I'm out. I'm not hanging around beyond that no matter what, right? It's the math, you could continue to rise, and I don't go back and look to say, well, did I miss out on something? Don't worry about it. There are plenty of opportunities. The biggest, the mistake to me that people make is just thinking, well, I should have stayed, or, oh, I've missed out on something. No, the market is a cornucopia of opportunity. Sometimes there are more, and sometimes there are less, but there are always opportunities to do things using supply demand divergences. And if you think that way, and you set your expectations low, just be happy with a point or two. Look, you can do very well with limited risk, and the math just keeps reinforcing that. Okay, last thing. Well, I only will talk, I'll skip the last two, then I'll talk about what's ahead, but I want to make sure I answer questions. Ileana, semis, okay. Still, is this a situation where nuance comes into play? Maybe. I mean, would I buy semis right now? No. I mean, to me, semiconductors, tech, they tend to lead momentum. So if I'm looking at semis here, yeah. I mean, everybody's covered. You could see that in almost everything somewhere, that there's been a lot of reduction of short positions, which to me is a mistake. Now, I could be wrong, right? It could be wrong. I don't know that it's going to reverse, but I'd look at this and say, absolutely, this is not the time to be in semis. To me, when there's strong divergence is a much better time. There's not a perfect example here. This was pretty good. Early March, when the demand was ramping and supply was insufficient, that was a great time, and it was above 5. Oh, now it's returned. So whatever opportunity there was, to me, that's all gone in semis. And if you look at the tech sector, tech, this is fine. There's been an insufficient level of supply, and so the sector has done pretty well. Certainly had a great first quarter, and it's been slow giving that back. But I'd look at that and say, it's not the entry point. The entry point is when these things are moving opposite. The exit is when they begin to converge. If you've been in it, take your gains. You can always come back. But to me, all over the math right now, it's telling us to be very cautious. I realize that the market, if you look at the market, it doesn't say that, but the math does. And so the only thing that has not yet happened is a reversal of that. But that's probably coming. So that's my comment on next. Options expire. I expect that to go up. Yes.
Yeah, for semi, TSMC reports next week. They're 65% of leading edge chips in the world. March, their revenue was down considerably year over year, like 15%. AMD and such are real, and Apple use TSMC, so they're going to be a broad indicator what semi does. And if you look at their chart, it's not rainbows and kittens.
Boy, there you go. Yeah, there's a downtrend in the supply side, but the demand is really deteriorated. And the last thing that left to happen would be a move here. That's really low. There's no question. It's abnormally low. But that also is to me a warning. These are conditions that are unusual, particularly that steep decline on the supply side. It's unlikely to continue. So we've gone pretty long here today. Apologies. So next Thursday, let's pick it up. We'll be right in the middle of options expirations, and we can remember what we talked about today, and we'll look at where we are then. So I'll see you then. Enjoy the weekend. I think we get snow and rain here, but it's been like 85 in Denver, but it'll warm right back up. We've been on the bikes a lot. Hope you guys have a good weekend. See you next week.
Thanks, Tim.
Thanks, Tim.